students, this is Professor Vikrant Banacha. I welcome you all in the advanced accounting subject. I welcome you all in my YouTube channel. Today in the advanced accountancy we are going to learn about the insurance claim. First of all, what is insurance claim? So when business or company suffer losses to their stock, profit as well as assets due to the incidences like fire, accidents and other incidences. In such circumstances, claims filed for compensation is called as insurance claim. So whenever there is any kind of losses to the stock, to the profit or to the assets of the business organization, for the compensation of such incidences, the company filed the claims towards the insurance company. Those claims are called as the insurance claim. There are two parties involved under the insurance claim. One is the insurer and another one is the insured company. So there are two methods to calculate the amount of the insurance claim. One is the loss of stock and second one is the loss of profit. So whenever the incidences like fire, in that fire there is a damage to the stock of the business or company, for that the amount of insurance claim is find out, it is called as the loss of stock. And the another one is the loss of profit. Whenever there is a fire occurred in the business or company, at that time for some time of period there is no working, there is a lockout in the business organization. For that there is a no manufacturing, there is a no production, it will be affected on the profit and therefore it is called as a loss of profit. So according to these two methods the insurance claim is calculated. So one by one we have to understand what is loss of stock and what is loss of profit. So first of all we must know about the loss of stock. So let's begin with the loss of stock method. According to that the insurance claim is final. So there are several steps under the loss of stock. Those steps we have to perform and then we can get the amount of the insurance claim according to the loss of stock. So first method, it is loss of stock method for the calculation of the insurance claim. Under that first step that we have to perform, we have to calculate the gross profit by preparing what? By preparing trading account of previous year. By preparing trading account of the previous year, we have to find out the gross profit. Then we have to perform the second step. Under that we have to find out percentage of gross profit by using this formula. The formula is very simple: gross profit upon sales into 100. By performing this formula, we have to calculate the percentage of the gross profit. Then in the third step, we have to prepare memorandum trading account. Memorandum trading account, it is from the first date of the accounting year till the date of fire to find out what? To find out the stock on date of fire. To find out the stock on date of fire, we have to prepare the memorandum trading account. And then in the fourth step we have to perform, under that we have to find out the loss of stock. Under the fourth step we have to find out the loss of stock. How to find out that? There is a very simple formula: stock on date of fire, then less salvage stock. Salvage stock means what? The stock that is saved in the fire, by deducting the salvage stock from the stock on date of fire, the amount we get, that amount is called as loss of stock. So in this way we can get the amount of the loss of stock. And now finally the fifth step we have to perform, it is calculation of the average loss. So before going to understand this step, we must know what is the average clause. So average clause, it is implemented in the under insurance. So whenever any business, any company, they are going to take the insurance policy, at that time they have to pay the insurance claim. When the amount of policy is more, at that time the premium amount is also more. Therefore, to lessen the burden of the premium that is paid for the insurance policy, the average clause is calculated. So therefore it is always implemented in the under insurance. Means what? When the loss of stock, when the loss of stock means what? The stock on date of fire is more than the amount of the policy taken. In such case, the average clause is implemented. What is that? When the stock on date of fire is more than the amount of policy, at that time we have to implement the average clause. And if the stock on date of fire is less than the policy amount, at that time average clause is not implemented. This is the most important thing that you have to remember. Now, the formula of the average clause is net claim is equal to amount of policy upon stock on date of fire into loss of stock. With this, finally we can get the net claim, that is our answer. So these are the 5 steps involved into the loss of stock method of the insurance claim. Quickly we have to revise. First of all, we have to prepare the trading account of the previous year to find out the gross profit. Then in the second step, we have to calculate the percentage of gross profit by implementing the formula gross profit upon sales into 100. Then in the third step, we have to prepare the memorandum trading account to find out the amount of stock on date of fire. The memorandum trading account for the period first date of the accounting year till the date of fire. And then we have to perform the fourth step to find out the loss of stock. Stock on date of fire minus salvage stock means save stock, we can get the loss of stock. And finally the average clause, that is net claim, is equal to amount of policy upon stock on date of fire into loss of stock. So these are the 5 steps, those are involved under the loss of stock method. Now move towards the next method. It is the loss of profit method. So loss of profit means what? Whenever there is an incident like a fire, at that time the fire that is affected on the business organization, to recover from the case of fire, business organization requires some period of time. During that, there is no work in the organization. There is a stoppage of work. Means there is no work, therefore there are no sales. And whenever there are no sales, there is no revenue for the business organization. And whenever there is no revenue, at that time there is no profit of the business organization. Therefore it is called as a loss of profit. To recover from that, the business organization, they are taking the policy, and accordingly this method they are finding out the amount of the insurance claim. So first step under the loss of profit, it is calculation of short sales. Calculation of short sales. So the formula of the, before going to understand the formula of the short sales, we must understand the one important concept, that we have to use under the calculation of short sales. It is called as the indemnity period or dislocation period. Indemnity period or dislocation period, it is the time through that there is no work in the business organization. That time is called as the indemnity period or dislocation period. That is most useful for the calculation of the short sales. Therefore, the formula is short sales, sales during corresponding indemnity period. And expected percentage of increase less sales during indemnity period, and then from this calculation the amount we are getting, that amount is called as the short sales. It is a formula. Corresponding indemnity periods means what? It is a previous year indemnity period. Okay. Under that we have to add expected percentage of increase if it is given. If not given, then don't add. And then we have to less the sales during current indemnity period. So in this way, we have to find out the amount of short sales. That is the first step. And number second step, it is the percentage of gross profit. Percentage of gross profit. For that, the formula is percentage of gross profit is equal to net profit of previous year plus insured standing charges upon sales during previous year into 100. This is the formula. With the help of this, we have to find out the percentage of gross profit. What is the formula? Percentage of gross profit is equal to net profit of previous year plus insured standing charges upon sales during previous year into 100. With the help of this formula, we can find out the percentage of the gross profit. Now the next step, it is the step number 3 that we have to perform. It is calculation of gross claim. Under the step number 3, we have to calculate gross claim. And for that, gross claim is equal to percentage of gross profit into short sales. It is the formula of the gross claim. Very simple formula is there, percentage of gross profit into short sales. And then now last step, it is average clause. Average clause. For that, the formula is net claim is equal to amount of policy upon insurance cover required into gross claim. And how to find out the amount of insurance cover required? The formula is there. Insurance cover required is equal to percentage of gross profit into adjusted sales. Percentage of gross profit into adjusted sales. Adjusted sales means what? These are the sales. Those are on the date of file for the previous 12 months, means for the previous 1 year. So average clause is implemented here when the amount of insurance cover required, is more than the amount of policy taken. At that time only average clause is implemented. If the insurance cover required amount is less than the amount of policy, at that time it is not implemented. Average clause is not implemented. Understood? So in this way it is the loss of profit. Again we have to revise. Under the loss of profit, first of all we have to calculate the short sales, and the formula of the short sales is sales during corresponding indemnity period add expected percentage of increase less sales during current year indemnity period. Then second step, percentage of gross profit. Percentage of gross profit is equal to net profit of the previous year plus insured standing charges upon sales during previous year into 100. Then step number third, it is the gross claim. Gross claim is equal to percentage of gross profit into short sales. And the last step, number 4, it is the implementation of average clause, and the formula is net claim is equal to amount of policy upon insurance cover required into gross claim. And how to calculate the insurance cover required? It is percentage of gross profit into adjusted sales. Understood this? So in this way it is the loss of profit method. So the students, these are the two methods. According to that we have to calculate the insurance claim. One is the loss of stock and another one is the loss of profit. I hope you have understood all the concept regarding the insurance claim. Such videos regarding the advanced accountancy topic I will prepare and upload on my YouTube channel. Kindly subscribe my YouTube channel, like my videos, and also press the notification button in the app. Thank you.